Hello everyone. Now let's continue our discussion for Chapter 11 about liabilities and more specifically about bonds. And we're going to be going over the scenario of a premium or bonds issued at a premium. So as we said before, if the market rate of interest is less than the contract rate of interest, the bonds will sell for more than their face amount. And the reason behind that is because investors are willing to pay more for bonds that pay a higher contract rate or a higher interest rate of interest than the rate they could earn on similar bonds, which is the market rate. Why? Because in this case our bonds are more attractive. So again, the rules of supply and demand, and of course we need to get compensated for why we are paying more interest compared to the market. So assume that on January 1st, Year 3, Northern Idaho Transportation Incorporated issued the following bonds. It has a face amount, or they have face amounts of $100,000. The contract rate of interest is 12% compared to the market rate of interest, which is 11%. The term of the bonds is again 5 years, and the interest is paid twice a year, semi-annually, on June 30th and December 31st. So since the market rate is below the contract rate, so in this case we expect that the bond would be issued at a premium. So because the contract rate of interest is more than the market rate of interest, the bond will sell for more than their face amount. And let's assume that the bond sells for $103,769. And by the way, there is a way to calculate it, but for the sake of this chapter, we're not going to focus too much on this. It's going to be given to you. The entry to record the issuance of the bond would be as follows. We're going to debit cash for the full value, the $103,769. We're going to create a liability for the bonds payable by crediting bonds payable for $100,000, and the difference would be credited to premium and bonds payable. So remember, I told you discounts are normally on the debit side, premiums would be on the credit side whenever we are issuing them. Then we're going to amortize the premium. In this case, the premium would be amortized on the credit side, on the debit side. Now it's on the credit side, we're going to amortize it on the debit side. So the premium is the market's way of adjusting the contract rate of interest to the lower market rate of interest. The account, premium on bonds payable, has a normal credit balance. It is added to bonds payable to determine the carrying amount or the book value of the bonds payable. So on the balance sheet, we're going to see bonds payable plus premium on bonds payable. And that's how we get the book value or the carrying amount of the bonds. So now let's talk about the amortization of the bonds premium. So like bond discounts, a bond premium must be amortized over the life of the bond. The amortization of the bond premium decreases the contract rate of interest on a bond to the market rate of interest that existed on the date the bonds were issued. The amortization can be computed using, again, either the straight line method or the effective interest rate method. But as I said before, for the sake of this chapter, we're going to focus only on the straight line. For those interested to learn more about the effective interest rate or the effective interest rate method, there's a good discussion in the appendix of this chapter, but I'm not really covering it in this video. So the entry to amortize a bond premium would be as follows. We debit the premium on bonds payable and we credit the interest expense. Also, the preceding entry may be made annually as an adjusting entry, or it may be combined with a semi-annual interest payment. So in the latter case, it would be as follows. We're going to debit interest expense. We're going to debit the premium bonds payable because now we're amortizing it. And we credit cash for the total. So the sequence we usually do is that we start with the cash, we amortize the premium, and then the difference between these two values would be the amount of interest expense. So that's the sequence that we have to follow when we are doing the math. So let's see an example. So the amortization of the preceding premium of $3,769 would be computed using the straight line method as follows. So we have the premium to be $3,769. We know the term of the bonds is 5 years, but it's semi-annual. So we have to calculate the semi-annual amortization by taking the 5 years, multiply them by 2, and then dividing the 3,769 by 10, and that would be the amount of the semi-annual amortization, which is $376.90. The combined entry to record the first interest payment and the amortization of the premium would be as follows. And by the way, it's going to be exact same journal entry for the 10 periods, or the 5 years, or the 10 interest payments. So the interest expense is going to be debited. We debit also premium and bonds payable, and then we credit cash. So for the numbers, we start with the cash, and this is where we are going to get the 100,000 multiplied by 12%, multiplied by half, or 6 over 12, and that would be $6,000. We also did the math for the semi-annual amortization, so we're going to debit the premium for $376.90, and then the amount of interest expense would be a plug-in amount where we get the difference between these two values. So 6,000 minus 376.90 would give us 5,623.10. So the effect of the premium amortization is to decrease the interest expense. This decreases the rate of interest to a rate of interest that approximates the market rate. As the premium is amortized, the carrying amount of the bonds decreases until it equals the face amount of the bond on the maturity date. So now we've seen the case of issuing a bond at its face value, where the market rate was the same as the contract rate. And then we've seen the two scenarios where we had the bond discount and we had the bond premium. Now let's see the bond redemption, or in other words, when we are calling back the bond. So a corporation may redeem or call bond before they mature. Callable bonds can be redeemed by the issuing corporation within the period of time and at the price stated in the bond indenture. Usually you have to pay the bondholders a little bit higher than its face value, so you can call it back. So normally the call price is above the face value. A corporation may also redeem its bond by purchasing them on the open market. A corporation usually redeems its bond at a price different from the carrying amount or the book value of the bond. So we might have a gain or loss. A gain or loss may be realized on a bond redemption based on the following situation. So a gain is recorded if the price paid for the redemption is below the bond carrying amount, or the book value of the bond. So if we were able to buy back the bond at a price below its carrying value, then we have a gain. A loss, on the other end, is recorded if the price paid for the redemption is above the carrying amount. So we paid more than its book value. And here we're talking about the company buying back its own bonds. So they might have to pay a little bit higher compared to its book value, and in this case they will be facing a loss. So gains and losses on the redemption of the bonds are reported in the other revenues and expense section of the income statement. So assume that on January 30th, a corporation has the following bond issue. They have the face amount of the bonds for $100,000, and they have a premium of the bonds payable for $4,000. So in other words, the carrying value on June 30th would be $104,000. On June 30th, the corporation redeemed 1/4, or $25,000 of the bond in the market for $24,000. The journal entry to record the redemption is as follows, and we have to pay attention to the sequence that I'm going to be talking about. So keep in mind, we paid $24,000, so that's the easy part. We're going to credit cash. So the cash is going to be credited to $24,000. And we are redeeming bonds that has a value, or that have a value of $25,000. And remember, if I go back here, the bond, or these bonds, they have $4,000 premium on bonds payable. So for the $100,000, they have $4,000. So if we bought back or redeemed 1/4 of this value, which is the $25,000, then we have to also redeem, or we have to cancel the premium on the bond for 1/4 of the $4,000, which is $1,000. And that's why the bonds payable here is $25,000, and we're debiting it, we're canceling it. We are also canceling the premium on bonds payable for the $1,000. So that makes a total of $26,000. So something that has a value of $26,000, we only pay $24,000. I think we did a good deal. So there's a gain on the redemption of the bond of $2,000. Gains are like revenues. They are recorded on the credit side. So now we have recorded the gain on redemption of bond for $2,000. So the sequence that I prefer that we follow, we start with the cash. It's easy on the credit side. We'll leave some room for the debit side. Think about the bonds payable, $25,000. Think about its related premium on bonds, which is $1,000. Then we need to match the debit and credit, so we are plugging in $2,000 here for the gain on redemption of the bonds. So only the portion of the premium related to the redeemed bonds is written off. The difference between the carrying amount of the bonds redeemed and the redemption price is recorded as a gain. Now let's assume that the corporation calls the remaining $75,000 of outstanding bonds, which are held by a private investor for $79,500. So they paid $79,500 for the remaining $75,000. The entry to record the redemption would be as follows. Again, we're going to do the same thing. Cash is pretty straightforward. We're going to credit cash for $79,500. We paid this cash. And then we are going to get rid of the bonds payable by debiting it for $75,000, getting rid of its related premium, which is the remaining $3,000 premium on bonds payable. So for something that has $78,000 book value or carrying value, we paid $79,500. Was that a good deal or bad deal? Actually, wasn't a very good deal. We had a loss on the redemption of the bond of the difference, which is at $1,500. Remember, losses are like expenses, they appear on the debit side. So we have the loss on the redemption bond, on the redemption of bonds would be the plug-in value of $1,500 here. So the total would be $79,500 debit, $79,500 on the credit. So the difference between the carrying amount of the bond redeemed and the redemption price is recorded as a loss. Now let's talk about reporting the bonds payable on the financial statements, and more specifically on the balance sheet. Bonds payable are reported as liabilities on the balance sheet. Any portion of the bond that is due within 1 year is reported as a current liability. Any remaining bonds are reported as a long-term liability. So anything that's beyond 1 year would be a long-term liability. Any unamortized premium is reported as an addition to the face amount of the bond, and on the other side, any unamortized discount is reported as a deduction from the face amount of the bond. The description of the bonds should also be reported either on the face of the financial statement or the accompanying notes. And here we have an example for PepsiCo, which is the company that manufactures Pepsi or Pepsi product. And here we have the accounts payable, we have the current maturities of long-term liabilities and other debt obligations for the total current liabilities. And then we have the long-term debt obligations and other liabilities and deferred income taxes. So this is how you can see the long-term debt obligation is represents the bonds payable for the company. So in the footnotes, they have the following table summarizes the company's debt obligations, and they have this portion that's due on 2020, 21, and so on. So they have a very good explanation. They broke it down year by year based on their maturity. And then less the current maturities of long-term debt obligations to get the total liabilities. So you see here the debt obligations that the 72 or actually it was the 29,148 this is the value that we have here. The last thing here is doing some kind of analysis for decision making, and the ratio that we're going to learn today is times interest earned. And this is a little bit different kind of ratio, but I think it's also useful. So assets of a company are subject to claims of creditors and the right of owners. As creditors, bondholders are primarily concerned with the company's ability to make its periodic interest payments and repay the face amount of the bonds at maturity. So anyone who's interested in borrowing money, usually the lender would be interested to know the times interest earned. Or in other words, how much they have an earning that can cover the amount of interest earned or interest expense per year. So analysts assess the risk of bondholders will not receive their interest payments by computing the times interest earned ratio during the year as follows. So it's calculated as follows. You can see here, income before income tax, which is a value we can get from the income statement. Then we add back the interest expense, because interest expense in this case is part of, we need to add it back to the amount of income, and then we divide it by the interest expense. So we can see like how many times the income plus the amount that was already paid for interest expense can cover the amount of interest expense. So the ratio computes the numbers of times interest payments could be paid out of current period earnings. High values of this ratios are considered very favorable. In contrast, low values are considered unfavorable. Values of this ratio less than 1 suggest that the firm is unable to cover interest payments from income before taxes, which is a dangerous situation. Such a situation could eventually lead to a loan default. So let's see some numbers here for companies we all know: PepsiCo, Coca-Cola, and Keurig, Dr. Pepper Incorporated. So the interest expense for PepsiCo is the highest here. We can see it's about I would say this is 1 billion, 135 compared to 946 million and 654 million for Keurig. Income before income tax, again you can see that Coca-Cola has the highest, PepsiCo is very close to it, and then Keurig Dr. Pepper is the lowest. So let's run the numbers and see how this would look like. So by running the ratio, you can see that the times interest earned for PepsiCo it's 9.2, for Coca-Cola it's 12.4, and for Keurig it's 3.6. So of course Coca-Cola has the most favorable situation, but Keurig Dr. Pepper has the lowest situation. PepsiCo is not too far from Coca-Cola. I think it's relatively good, but it's still lower than Coca-Cola. So I hope this was easy. I think it's not a very long chapter, so please study hard and let me know if you have any questions. Thank you.